The student debt burden. It often starts with a single piece of paper, a university acceptance letter. It represents hope, opportunity, and the promise of a better future. But for millions of Americans, that promise is now tied to a crushing financial burden. The national student debt has swelled to an astonishing $1.7 trillion. This isn't some abstract government figure, it is a weight carried by more than 43 million people, from recent graduates to senior citizens still paying off their loans. So, how did a tool for advancement become a trap? Over the past 4 decades, the cost of a college degree has consistently outpaced both inflation and wage growth. A generation ago, a student could realistically cover tuition with a summer job. Today, that is a fantasy. As state funding for public universities declined, institutions raised their prices to cover the shortfall. To bridge this growing gap, financial aid shifted its focus away from grants money that doesn't need to be repaid and toward a complex system of federal and private loans. The result is a generation starting their adult lives in a deep financial hole. This debt dictates major life decisions. It means delaying buying a house, putting off marriage, or having children. It forces graduates into jobs they don't want simply for the higher salary. The diploma that was supposed to unlock a brighter future has, for many, become a key to a cage. This forces a difficult question. Is higher education still the reliable engine for upward mobility it was once sold to be? High-interest credit cards. It has a number often buried in the fine print, 29.99%. To most, it seems abstract. But that figure means for every $1,000 you carry as a balance, you could pay nearly $300 in interest over a single year. This isn't a loan for a house or a car. This is the world of high-interest credit cards, a financial tool that operates on a different set of rules. These cards aren't designed for the financially secure. They are marketed specifically to those who banks see as a gamble, individuals with poor credit scores or no credit history at all. The high annual percentage rate, or APR, is the bank's insurance policy against default. It's the steep price of entry into the credit system for those on the outside looking in. For the lender, the high rate is meant to offset the increased risk that the borrower might fail to make their payments. The math is unforgiving. A small, seemingly manageable purchase can quickly spiral. When interest compounds daily, the debt grows on itself. A $500 emergency expense becomes a $1,000 problem if only minimum payments are made. The minimum payment itself is often structured to keep the cardholder paying for years, with the bulk of each payment feeding the interest, not the original debt. The system offers a foothold on the financial ladder, but the rungs are dangerously slippery. For millions, the climb up becomes a desperate struggle just to living without a budget. The word budget often conjures images of complex spreadsheets and endless guilt over a $5 coffee. It is a financial straitjacket, meticulously tracking every dollar spent. But what if the path to financial control isn't found in restriction, but in its opposite? A growing number of people are ditching the budget entirely, not out of recklessness, but as a deliberate strategy. They are embracing a system that requires a different kind of financial awareness, one that prioritizes automation over constant monitoring. This approach is often called conscious spending, or an anti-budget. The core idea is simple: pay yourself first. Before any discretionary spending happens, money is automatically funneled to where it matters most. A fixed amount goes directly to savings, investments, and essential bills the moment a paycheck arrives. This isn't about ignoring where your money goes. It is about making the important decisions upfront, then letting a system handle them consistently and without fail. The mental shift is profound. Traditional budgeting forces you to focus on what you can't do. The anti-budget flips the script. Once the automated transfers are complete, the money remaining in your checking account is yours to spend, guilt-free. There's no need to track every small purchase because you know your long-term goals are already being funded. The question changes from can I afford this to is this purchase actually worth it to me? This freedom, however, relies on setting up the automations requires a clear, honest understanding of your true income and fixed costs. Get those calculations wrong, and the hands-off system can quickly steer you into debt. It demands discipline at the start, not daily. But what happens when a major, unplanned expense shatters that automated piece? Delaying compound growth. Most of us think about saving for the future in a straight line. We imagine that if we start 5 years later, we just need to save a bit more to catch up. But the math of compound growth doesn't work like that. It is a story of exponential curves, where early advantages become massive, unbreachable gaps over time. Consider 2 recent graduates, both starting their careers. The first, let us call her Sarah, begins investing immediately. She puts away $400 a month. Her friend, Michael, decides to wait. He wants to enjoy his 20s, pay down some minor debts, and figures he can easily make up for lost time later. He finally starts investing at age 30. putting away the exact same amount as Sarah, $400 a month. For the next 35 years, they both invest consistently. Michael is diligent, never missing a payment. He assumes he is only 5 years behind Sarah, but he isn't. He has a full decade of compounding behind her. By the time they both reach retirement at age 65, Sarah's portfolio is worth nearly double what Michael S's. Michael saved for 35 years. Sarah saved for 40. That small 5-year head start didn't he just add a little extra? It created a copy of his entire life savings. He wasn't just chasing Sarah's contributions, he was chasing the ghost of the money her money had already earned. Underfunding retirement. The idea of a secure retirement was once built on a simple model, a three-legged stool. You had a company pension, your personal savings, and social security. But over the last 40 years, 2 of those legs have been systematically weakened. Company pensions, once a bedrock of stability, have all but vanished for most workers. They've been replaced by 401 plans that place all the market risk and the burden of saving squarely on the employee. Simultaneously, that second leg of personal savings has been eroded by decades of stagnant wages and a relentless rise in the cost of living. Housing, healthcare, and education have become so expensive that they consume entire paychecks. For millions, paying down student debt or just covering next month's rent takes priority over a retirement account they can't afford to contribute to, let alone touch for another 30 years. This isn't a narrative of individual responsibility. It's the predictable outcome of a systemic shift. The social contract that once implied a dignified end to a life of work has been quietly rewritten without public consent. The result is a generation marching toward a finish line with no safety net, a society where working into your 70s or 80s is no longer a choice, but a necessity. They followed the rules, but the game was changed halfway through, leaving a fragile system balanced precariously on a single leg. The trap of lifestyle inflation. The email arrives. Congratulations on your promotion and salary increase. The feeling is electric. After years of hard work, you've earned it. The first thought isn't about saving more. It is about upgrading. Maybe it's time for that bigger apartment, the one with the balcony. Or a new car, something that doesn't make eye. This is the subtle beginning of lifestyle inflation. It is the natural tendency to increase your spending as your income grows. The occasional expensive dinner becomes a weekly habit. The budget airline tickets are replaced with premium seats. Each individual purchase feels justified, a small reward for your success. But taken together, they create a new, much higher, financial baseline. Your old standard of living starts to feel inadequate, even though it was perfectly fine just a few months ago. The problem is, your sense of financial security doesn't actually increase. You're making more, but you're spending more, often at the same rate. You're essentially treading water in a more luxurious pool. You're still just one unexpected expense, one layoff, away from serious trouble. The safety net you thought the raise would build never materializes. It was spent, piece by piece, on a lifestyle that quickly became the new normal. The golden handcuffs click shut, not with a loud snap, but with the quiet hum of a new appliance you suddenly can't live without. You've successfully earned more, but have you actually gotten any richer? No financial safety net. It often starts with a single, unexpected event. A phone call from a landlord raising the rent. Sharp pain that turns into an emergency room visit. A sudden notification that your hours at work have been cut. This is the moment the floor gives way, revealing just how little was holding you up. There's no safety net. This financial precarity isn't a personal failing, it's the new landscape. Decades ago, a long-term career with one company could secure a pension and robust benefits. That model is now a history for most. It was replaced by the promise of flexibility and entrepreneurship in a gig economy, a system that offloaded all the risk onto the individual worker. At the same time, the costs of basic necessities, housing, education, and healthcare have soared, vastly outpacing wage growth. Student loan payments consume the portion of a paycheck that might have once gone into savings. High-deductible insurance plans mean that even those with coverage face thousands in out-of-pocket costs before their benefits even begin. It is a perfect storm where income is less stable and expenses are more volatile. The result is a quiet, constant anxiety, the feeling of running a race on a treadmill that is slowly speeding up. The old roadmap to a stable middle-class life appears to be written in a dead language. So if the traditional pillars of security have crumbled, what new structures are people desperately trying to build in their place? Overspending on cars. It sits in the driveway, gleaming. For millions, it is the second biggest purchase they'll ever make. For a growing number, it's the purchase made asterisk instead asterisk of a home. We tell ourselves it's a necessity, a tool for getting from it to be, but the numbers tell a different story. The average new car loan now stretches to nearly 70 months. That's almost 6 years of payments for an asset that loses a fifth of its value the moment you drive it away. What are we really buying? It's rarely just 4 wheels and an engine. We resold a story. A story of freedom, of arrival, of success made tangible. Dealerships understand this psychology perfectly. They don't sell a $40,000 vehicle, they sell a $500 monthly payment. Stretch that payment over 7 or 8 years, and the unaffordable suddenly feels manageable. It's a subtle trap, baited with low interest offers and the promise of that new car smell. But this single decision creates financial ripples that last for years. That monthly payment isn't just a line in a budget. It's the investment account not opened, the student loan that lingers, the down payment on a house that remains just out of reach. The car becomes an anchor, holding your finances in place while demanding to be paid for the illusion of going somewhere. The real cost isn't just the sticker price, it's the time and opportunity you trade away. Buying too much house, it starts with a number. A big, exciting number from a mortgage lender that tells you just how much house you can afford. Suddenly, the possibilities expand. The 4-bedroom colonial with a huge backyard, the modern build with the chef's kitchen, it all seems within reach. You sign the papers, get the keys, and celebrate. But a few months later, a different reality sets in. The heating bill for that cavernous living room is double what you expected. Property taxes are a gut punch. And every weekend seems to bring a new, unexpected repair, from a leaky faucet to a faulty garage door opener. This is a state of being house poor. It is a quiet crisis where your home, your biggest asset, becomes your biggest liability. The mortgage payment is just the entry fee. The true cost includes insurance, maintenance, and the constant need to furnish and fill the extra space you thought you wanted. Your income is swallowed whole by the house. Vacations become a distant memory, saving for retirement feels impossible, and even a simple dinner out with friends requires a budget calculation. The dream home has turned into a gilded cage, trapping your finances and limiting your life. It forces a difficult question. What's the real price of a dream, and is the house itself worth more than the life you live outside of it? Insufficient insurance coverage. When the last ember is extinguished and the emergency crews depart, a family stands on the curb, staring at the shell of their home. Amid the shock, there's a single thread of relief. They have insurance. They've repaid their premiums diligently for years. They believe they recovered. This belief shatters a few weeks later when the insurance adjuster calls. The payout they reoffered is nowhere near enough to rebuild. The problem isn't the insurance company trying to cheat them, it's the policy they themselves signed. Their coverage was based on the home's purchase price from a decade ago, long before a new kitchen and a finished basement dramatically increased its value. The policy also specified actual cash value. This means the insurer pays for their 10-year-old roof and aging appliances, minus depreciation. It doesn't cover the much higher cost of buying everything new. This is the critical difference from replacement cost coverage, a gap that can easily amount to tens, or even hundreds, of thousands of dollars. Families suddenly find themselves financially devastated by the very catastrophe they thought they were protected from. They had a policy, but what they didn't have was a plan for reality. Not negotiating your worth, the email lands in your inbox. The subject line reads, "The job offer." A surge of relief, then excitement. You scan the details, the start date, the benefits, and finally, the salary. The number is solid. It is acceptable. But deep down, a quieter, more hesitant voice chimes in. It asks if this number truly reflects your skill, your experience, your potential. This is the critical moment where most people falter. The fear is immediate and visceral. Fear of seeming greedy. Fear of being difficult. Fear that the company might just withdraw the offer completely. This isn't a personal failing, it's a feature of our mental wiring. We are socially conditioned to avoid conflict and rejection. Psychologists point to loss aversion, where the pain of losing something we believe we have the offer feels far more potent than the potential reward of gaining more. This pattern isn't just about money. It is in the project deadline you accept without question, or the extra work you take on without a promotion. Each time we bypass a chance to define our own value, we set a precedent. That initial salary becomes an anchor, weighing down every future raise and negotiation. The financial gap created by that one moment of silence doesn't just persist, it widened, compounding over an entire career. The real question isn't what you might lose by asking. It's what you are guaranteed to lose by not. The high cost of inaction. In 1975, a young Kodak engineer named Steven Sasson invented the first digital camera. It was a clunky device, the size of a toaster, that captured black and white images on a cassette tape. When he presented his creation to executives, the reaction wasn't excitement, but fear. They were guardians of a global monopoly on photographic film, a business that generated immense, reliable profits. The new technology was seen not as an opportunity, but as a direct threat. The message was clear: keep it quiet. So they buried the project. For over a decade, Kodak held the head start on the future and chose to do nothing with it. They reasoned that disrupting their own film business would be financial suicide. Instead, they watched as competitors like Sony and Canon started developing their own digital cameras through the 1980s and 90s. Kodak's leadership believed their brand was invincible, assuming the transition away from film would be gradual, giving them plenty of time to adapt when necessary. They miscalculated catastrophically. The shift, when it came, was sudden and brutal. Consumers abandoned film with breathtaking speed. By the time Kodak finally committed to the digital race, they were hopelessly behind. The market they once owned was now led by the very companies that embraced the technology Kodak pioneered. In 2012, the company that taught the world to capture memories filed for bankruptcy. It is a classic story of an organization so invested in its present success that it actively chose to sacrifice its own future.